The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.
Well, as we look at Tuesday's market action, the soy complex is where most of the fanfare was in the grain trade. A little bit of a late push in the soy complex. We look over at livestock, pretty robust day in cattle and hog futures as well. Got plenty to take a look at and talk about. Joining us for a conversation on today's Market Talk, Brian Splitt with agmarket.net. Brian, good to talk with you again, buddy. Hope you're doing well.
Yeah, I'm doing fantastic. Always good to be here, Jesse.
Well, let's start with soybeans here today, Brian. That was kind of, I'd say, the one of the winners of the day. A late push there. I didn't see much in the way of news headlines, so wondering if some of this is maybe some folks coming back in and bargain hunting a little bit here potentially in the case of soybeans. I guess I don't know. What are your thoughts with the soybean action we saw on Tuesday?
Yeah, it was definitely a good close. We were able to push through last week's highs and close above them late in the session. And with corn and wheat, everything was higher this morning. Corn and wheat backed off, and beans backed off with them. Did not go negative like the other two did. And then we just saw it kind of climb back, make new highs late in the session. And there were some rumors when we were testing $12 that maybe China was canceling purchases that they had made, and that doesn't seem to be the case. And if anything, we had a fresh sale that was announced here, and maybe with the type of trade that we're having right now, we might see some more of those sales to come. Generally, when China cancels, because China has multiple entities that buy, if it's COFCO and it's like the state-run agency, they're probably not canceling. If it's the crushers that are buying, and if their margins turn negative, they're the ones that will typically cancel. So we haven't seen anything out of that, but just the fact we were able to get through the 10-day moving average, hold that, then we got through last week's highs and closed above it. I think that looks positive. So now the next level that beans need to get above in order to continue this technical short covering would be, there were three highs that we made just before the January report: 1251.5, 1250, and 1249.75. So if we can get through that little shelf, then it looks like the next thing would be to try to fill that gap up there at 1296.75. And I think that could be something that happens sooner rather than later. You just think about all the information that we digested with soybeans. And I personally believe that the numbers that we just saw for South America's total production between Argentina and Brazil are going to be the largest numbers that we get from the agencies, if you will. Now we've got a forecast for hot and dry in Argentina for at least the next 10 days. And if that continues past that, then that's going to become a little bit more of a story. Their crop is not done yet. It's still in the vegetative stage. So there's still a lot that needs to happen for that crop to reach its full potential. So some hot and dry here at this stage is likely to then back off some of those estimates. And we're still too high on the Brazilian crop here. So USDA at 157 is not where the market is. And we got an outfit, Agro Consult, that's like the Cadillac of the crop tours in Brazil, and they're doing their deal right now. So it'll be really interesting to see where they put the total Brazil crop when they're done.
Yeah, it would be very interesting. And I think some of these weather challenges are kind of creeping in here a little bit back into the market sentiment anyway that you mentioned. In some cases too, we've seen rain in parts of Brazil that could possibly hamper and delay some of the soybean harvest, which could spill its way over into safrinha corn planting too. I know that's another piece to this South American puzzle that could have some market impacts here over the next, I'll say, 3 to 4 weeks, Brian.
Yeah, I mean, you talk about that dynamic. Any rain here into harvest, and if it sticks around, and now you've got the crop that's kind of sitting in standing water, that's not good for the crop itself. We saw that actually happen in Argentina in 2016, where they had a great crop in the field, and then it just started raining and wouldn't stop, and there was flooding, and they were estimating that we were going to lose about 10 million tons of their production just because of that flooding. They overdid it. We only lost about half that, but they priced it in, and they priced it in very quickly. So you never know what's around the corner. As far as corn goes, it's a couple things. That harvest delay then delays the seedings of the safrinha crop. But I've also heard talk about just the sheer economics in Brazil because of the price devaluation. And are the producers going to plant aggressively for that second safrinha crop? Are they going to throw the kitchen sink at it as far as inputs to make sure the crop yields as much as possible? Or is this something that the producer pulls back on as far as some investment there? I've also seen talk about some of the early planted beans in the Mato Grosso area not being harvested and just planting corn right now. So there's a lot of stuff that's still going on right now that this market needs to digest and figure out.
I think we could probably safely say, and you can correct me if I'm wrong, that the 1201 low here in soybeans probably a solid area of support at this point. But on the flip side, in corn, I'm wondering what is our good support area here, or are we able to maybe slowly bounce off the bottom here in corn? I guess talk about that a little bit for me, Brian. I mean, realistically, what are we looking at here in this corn market that's been pretty quiet lately?
Yeah, there's a little bit of a difference between corn and beans, and that's how much the producer owns. And so when you look at that 1201 low in beans, just the fact that we're now nearly 40 cents off of that, it looks really good, right? It's, oh, all right, that was a good strong low, and we're coming off of it pretty aggressively. For corn, I think we tested very good support. So you could look at a continuous chart for corn. And for those that are listening and don't know what that means, that's a chart that always shows the front month contract at any given time. And so when you go back over the last, decade and put yourself back into that 2014 through like 2019, 2020 period, the 440 area was like the upper end of the trading range. And then in 2020, after commodities made that COVID-induced low, and then China came in and bought product at multi-decade lows, we then took that 440 area out, and that was a very strong breakout to the upside. We all know what happened from there. So I'd like to think that old resistance is now new support. We definitely want to see corn hold that 440 zone. And we're talking highs that were like 437 and a quarter, 438, 439, right? They were all mingled in that area. So with last week's low at 436 and 3/4, we went right to that area. We caught right where we should. It just hasn't bounced off of that level as nicely as the soybeans have. We pushed through 450 very briefly, saw 450 and a half. And then I think you saw some very short-term profit taking. I think people are still nervous to hold corn longs. But now if we can get above 450 on a closing basis, I think that would go a long way. And like you said, we're getting into the acreage discussion here. And let's not forget the month of February sets our spring averages for crop insurance levels. Mm-hmm. And I wouldn't be surprised if we actually had the market go up into February so that our average prices are higher than where they are currently.
Yeah, we were chatting about that before we went live, the acreage discussion. And I know Farm Futures released their acreage estimates on Tuesday morning, and mostly marginal changes. But the big one that stood out to me was the potential of spring wheat acreage being down quite substantially, and the talk of some of those fringe acres, as we've called them before, switching over to, say, soybeans. I guess overall, Brian, this acreage discussion is really going to be, I think, a big story here over the next couple of months.
It is. I mean, the market, has had so much bearishness to focus on. What is the next bearish thing? And I think we've dealt with a lot of bearishness. So there are some positive things that are out there. Some of it's just cyclical as far as timing goes. And like we said, setting spring averages for crop insurance hopefully is a positive time where you can move those levels higher. But you're right. You look at that spring wheat, and the estimate was that we're going to be down a little over 2 million acres year over year for spring wheat. So if that comes to fruition, then we're really going to be focused very intently on the winter wheat crop and what things look like coming out of dormancy. And if it looks like there's any concern there, if there's stress, and we'll see how weather evolves in the plains up into that point, but that'll then put some pressure on spring wheat to maybe rally to get some of those acres back, because we may need them in the big picture if the winter wheat is running into some issues. So we'll see how that comes about, but that's definitely a story to watch moving forward.
We're having a conversation today with Brian Split from agmarket.net. And Brian, I know too in the wheats, KC wheat had a pretty decent day on Tuesday. But to your points, really watching that crop, that winter wheat crop, come out of dormancy, that's going to be a big key. And thinking too along this acreage discussion, I look to the south. I know cotton has had a pretty good run here as of late, and just thinking about some of these outside markets and the potential they could have, I think overall the running theme that we always hear and I continue to hear is that corn and soybean rotations in the heart of the Corn Belt are probably going to stay the same, but it's some of these outside areas too. And I just, it makes me wonder. You raise great points here, thinking about, okay, spring wheat side, I think about cotton in the south and the delta as well. There's a lot of shifting parts here, and throw on top of that too the overall economy and some of the money flow into outside markets. There's a lot kind of churning around here that could add on to what we're seeing in these commodities right now on the grain side, Brian.
Yeah, there was a lot of commodities that started the year very weak and have put in some lows early in the year and have started to bounce. Cotton's one of them. Cotton's had a very strong performance over the last couple of weeks. You think about what's going on in the meats right now, lean hogs, for example. We have been trending lower since about June in this April lean hog contract. We took out the downtrend today. We were sharply higher. We had two previous peaks that were just under 79.50 on the April contract. We blasted through that, went about another buck above it. So it looks like the hog market could have potentially broken out to the upside. We'll obviously want to see some follow through. And if nothing else, maybe revisit that support, hold it, and then look for some new highs afterwards. You look at live cattle and feeder cattle. We had the cattle on feed report last Friday. It was decidedly neutral. We saw some very short-term profit taking yesterday coming out of the weekend, closed off the lows. And then here we are today, both the live and the feeder cattle markets making new highs for this recovery bounce. So that's positive. And then maybe you shift over to the energies and take a look there. And you've got crude oil has been trending lower. Heating oil, which is your proxy for diesel fuel, has been trending lower. Both of those have taken out their downtrend lines. We're starting to build bases of support at some of these longer term moving averages in the energy markets. And we're definitely not at a shortage of geopolitical things going on globally that could very quickly and very easily turn those markets back to a positive sentiment. So, and it's interesting. I don't know why the Fed should really lower interest rates with the stock market doing what it's doing. And, the unemployment numbers where they are. The consumer sentiment made a huge jump here recently, but it seems like the market is preparing for the Fed to start going back into that thought process, and maybe it doesn't happen as soon as what they had hinted in their last meeting, but it seems like some of these commodities after the beatdowns we've seen are starting to find some value, and we're starting to see the markets, little by little start taking out resistance and build a good base.
I wonder too. I feel like, China's the big elephant in the room. I mean, China's got a mess on their hands with their economy from everything that we can tell at this point in time, Brian. So I wonder if, China's not necessarily in the grain buying and meat buying business as much as normal. Will we have to rely on more domestic demand here in the US or some of our other export partners? I think about Mexico, Canada, Latin America, Europe. I mean, thinking about China here, I'm very curious, I guess, to see just how bad this economic situation is over there and how it could impact the broader picture here in grains and livestock, Brian.
Yeah, there's a couple things with China. You talk about the economic side of it. The population is not growing. That's a problem, as far as big picture demand sentiment. We look at the amount of hogs that they liquidated and the losses that hog producers were taking. And so with all of those animals that were requiring feed before they were liquidated, it's now estimated that their demand for soybeans and soybean meal because of that liquidation is going to be reduced. And we're not going to need to see them buy at the same pace that they had been. So that's an issue. But it is one of those things where, yes, demand domestically is going to be something that we're going to be really looking at. And again, you think back a year ago and a lot of the talk in beans was positive about soybean oil because of the renewable diesel initiatives. And so these plants are continuing to come online. There was one in California that's a big one that was just approved here. And so that should be something that should be positive for overall domestic consumption. And as we continue to see more of these plants come online, we're just building a better and better domestic base of demand. You think corn for ethanol has been a bright spot, and we're still running above where the USDA has us as far as our pace. So I wouldn't be surprised to see the USDA increase the corn for ethanol demand on the balance sheets. I think, back to what more could be bearish. I mean, we had the final production numbers from the USDA. It was a bigger yield than expected, and everybody was so focused on that yield number being a new record that they kind of glossed over the fact that carryout only went up 30 million bushels from the previous month. And that's not I had people call me saying, I'm surprised corn's not limit down on that yield number. And it's not the yield that we're trading. It's the whole pile, right? The carryout, that's the big number. So to go up 30 million bushels from the previous amount, I didn't think was that bearish. And I think you could get that 30 million bushels back and then some from some additional demand that I think will come into the balance sheet. So I wouldn't be surprised if over the next 1, 2, 3, 4 months, our carryout is actually lower in corn than where it was in December. So I think there's things that are kind of shifting and turning here. And a lot of it may just be money flow. If the money flow doesn't want to be as short commodities as they are now, I mean, think about corn has the largest short position from the managed money at this time of year that they've ever had. And the last time they were roughly this short or close to this short was 2017. So what did they do? Well, in 2017, they went from short about 225,000 contracts in January. They covered those shorts. They actually went long into mid-March and were long 225,000 contracts. So you could very quickly see the fund shift for a 4 to 6 week period. Now, what I would caution you as far as what happened in 2017 is that whole buying spree from the funds, that 450,000 contracts, only rallied the March contract like 35 cents. So again, one of the problems is the producer still owns so much grain right now that they are going to be a constant natural seller in the marketplace as the funds are covering shorts.
You raised some great points here. Let's wrap up this conversation and, thinking about, you just said it. I mean, a lot of producers holding on to product right now. What would you remind folks in this environment as it looks like these markets are building a good base? What would you remind folks as they're trying to manage their risk right now, Brian?
Well, one of the concerns I have is if we do get the fund manager to cover corn shorts and the futures market does rally, and let's say it rallies the same percentage-wise as 2017, and we go up maybe 40 cents. What's going to perform better on that 40-cent rally? The futures going up 40 cents or your cash? And I think it's the futures, because if the market goes up 40, the basis is there to control the flow of cash grain. They can only handle so much of it. So I think you get a 40-cent rally, you may only see the cash market go up 20, 25 of that. I think basis is going to take a hit. So we've had some producers lifting hedges, selling the physical because the basis is improved, and then looking at re-owning it on the board. Because in our opinion, if the market were to rally, we're going to be able to reap 100% of that rally if we're long futures, where we don't feel that's the case in the cash market.
Brian, great stuff as always. And I know folks can reach out to you guys, look at your intel and more at agmarket.net. And they can also find more info about your conference coming up here just a couple weeks away here in Nashville, Tennessee. I know I'm looking forward to being there for 2 days. Give us a plug for the conference real quick, Brian.
Yeah, it's just under 2 weeks away. It's going to be that weekend between the conference championships and the Super Bowl. So Sunday into Monday, 2-day event. And check us. You just go to the website. There's a link there where you can register. If you're going to go, I would register quickly because we're running out of rooms. Our attendance is up significantly over the last year. It's going to be a great lineup.
It is a great lineup. Again, more details, agmarket.net. Brian Splitt, always appreciate the time, my friend. Thanks for joining us on Market Talk today, and we'll talk to you soon.
Sounds good, Jesse.